So up till now, we have mostly worked our way through our 1040. We're not quite finished just yet, but we're getting pretty close. And we will wrap it up when we start chapter 8 now. So guys, we started by picking our filing status and our exemptions. We know those goals now. We figured out what is and what is not gross income that gets reported on here. Then we spent time in chapter 6 and 7 and 13 looking at what are our 4 AGI deductions and how to calculate those. And we took some time looking at all of our itemized deductions and how to calculate those with all their various floors and ceilings, okay? And we said that even after you apply all those various rules, floors, and the ceilings, that our itemized deductions may still be further subject to more limitations, right? If you have a high earning taxpayer, that your itemized deductions may be even more restricted than they originally were, okay? Then we compare those to our standard deduction. We pick the biggest number as our first below the line deduction, and then of course we have our exemptions, which are our second below the line deduction, and those two we just found out are also possibly subject to a further phase out based on the taxpayer's AGI, okay? And now we have arrived at taxable income, and that's what we're gonna be focusing on for the next couple of classes. Guys, we know, because I've told you this before, that when you get to taxable income, you don't just run off and tax it using the regular tax tables, okay? Because you have to look back to your sources of gross income and figure, do I have a net long-term capital gain? Or really, we didn't focus on these, but do I have qualifying dividends? Because those two sources of gross income have special preferential rates, right? Our 0, 15, 20% rates. So you can't use the standard tax table for those. You have to calculate using an alternate method. And we are gonna look at another tax today, another income tax that uses an alternate method, okay? If there's a child who has to fill out a tax return and this child has more than $2,100 of unearned income, okay? We're gonna need an alternate method of calculating their income tax, and we'll look at that shortly, okay? Now, in addition to our income taxes, taxpayers may be subject to other taxes. If they're high earning taxpayers, guys, they're going to be subject possibly to the net investment income tax. This is a new tax in 2013 to help pay for Medicare, Obamacare. So that's a new tax. It wasn't around a couple of years ago, so you guys are lucky. And then also nowadays there is an extra Medicare tax for, again, high earning taxpayers. You might have to pay an extra 0.9% in Medicare taxes, and we'll look at that probably next class. And then apart from that, any taxpayer in general may be subject to what's called the AMT, which we'll look at today. And if you're self-employed, you might have to calculate your own self-employment taxes. Guys, these are really just FICA taxes, which I've told you in the past. FICA taxes are payroll taxes. It's Social Security and Medicare. If you are employed by an employer, they do all of the calculations and the withholding for you, so you have nothing to worry about. But when you're self-employed, you not only have to calculate all of this and pay it, but you're responsible for remitting these on a quarterly basis. So if you're self-employed, this is something above and beyond your income tax that you also have to think about. So after we finish taxes, guys, then we'll look at credits. Hopefully you're eligible for some credits, and that will reduce your tax bill. In some cases, those credits may lead to a refund. In other cases, it may just be able to have you wipe out your tax liability altogether. It depends on the type of credit. We'll learn there's 2 different types. And then the last part of the chapter, we're going to figure out, okay, what happens to these individuals' tax returns if they don't pay or file on time, what penalties they're subject to, and how do we calculate those. Or, and you guys have read by now, we have a pay-as-you-go penalties you face if you don't pay on time each quarter. Okay, so with that being said, let's wrap up our income tax calculations with the Kiddie tax, okay? Guys, the Kiddie tax applies when you have a child, and we'll look at that definition in a second, and they have unearned income of more than $2,100. If they don't have at least that much unearned income, the Kiddie tax is not in effect, and we don't have to worry about this, okay? Now guys, the idea here is that we talked about in chapter 5 the assignment of income rules. We talked about the Lucas v. Earl case with the lawyer who made the contract with his wife, whereby instantly, any monies earned by them during the course of their marriage became 50-50, and the courts kind of stepped in and said, wait a minute, you're the lawyer, you're the only person who could have serviced those contracts between you and your clients, therefore that income is your income. You can't shift it over to your wife and thereby reduce your marginal tax rate. And then the courts took that finding and extended it in another court case, Halvoring v. Horst, and they basically took the same rule and extended it to properties and unearned income. They said, look, children, I could very easily take my vast stock portfolio, which doesn't exist, and gift it to my 8-year-old son. My 8-year-old son wouldn't know what to do with this portfolio, so I could effectively still control it. It's within the family, and I could, like I said, gifts, guys, we know are non-taxable, so I can gift it to my son. There's no income tax effect to him. I could put it in his name, I could trade it, I could do what I want, I can earn all sorts of dividends and capital gains and interest on this portfolio. And because it's his and he owns it, I could, have everything taxed at his 10%, 15% rates rather than my 35% rate, okay? And this is the court's way, or I should say, this is Congress's way of saying, we can't let that happen. Again, so this is preventing an assignment of income really in a tight-knit sort of unit where it would be very easy to gift something away, but yet still have control of it, okay? So like I said, guys, this applies when you have a child, okay, and they have more than $2,100 of unearned income. And they give us a definition of who is a child, and unfortunately it's different than our definition of qualifying child in Chapter 4, okay? Here the rules say that the child has to be under 18 at year end, under 18 at year end, or he could be exactly 18 at year end, guys, but his earned income can't be more than half his support. This is all in the book, okay? Or he could be 19 to 23 years old, under 24, okay? He could be 19 to 23 at year end, and if he's a full-time, as long as he's a full-time college student and his earned income is not more than half of his support, okay? He can't be supporting himself. Okay. And what happens here, guys, if you do have a child who fits in this category and he does have earned income of more than $2,100, what's going to happen is they're going to take some portion of this income and they're going to tax it at the parent's marginal rates, the parent's highest rates. The kid's going to actually report it on his return, but he's going to have to do an alternate income tax calculation. He can't now use the basic 7-bracket system. But we're going to work through a calculation that says this portion of his unearned income is going to get taxed to his parents using their rates. And then anything that's left over will be taxed to the child using his rates. Okay. Now, guys, if you remember to the end of Chapter 6, I told you there's some information there that we were going to use when we got here, and this basic rule said that if you have a child, okay, who's being claimed as a dependent by another party, and this child has to fill out their own tax return, and someone claimed their exemption, okay, that child is not given the standard deduction amounts that we've gotten used to, okay? That child is not allowed to use a standard deduction. What the rules say in this case is that the child gets the lesser of $1,050 or $350 plus earned income. But his overall exemption, or I should say deduction, can't exceed what otherwise would have been a standard deduction. So presumably it's a child, they're single, $6,300. So you could take that $350, he might have a lot of earned income. So maybe he has $10,000 of earned income plus the $350. You would initially calculate a deduction of $10,350. But the rules go on to say, but his deduction can't be bigger than the general standard deduction he would have had. So you have to cap him at $6,300. We'll work through a bunch of examples. Okay. All right, actually, let's just do that because it's the best way to get through this one. Okay, guys, I'm going to go through number 54 in the book if you want to follow along. In 2015, Cheryl is claimed as a dependent on her parents' tax return. The parent's ordinary income marginal rate is 35%. Cheryl did not provide more than half of her own support. What is Cheryl's tax liability for the year in each of the following alternative circumstances? Okay. So her parents are claiming her exemption, which is telling us, guys, that she can't claim her own standard deduction of $6,300. We have to use the alternative for her. And they're giving us her parents' marginal rate, which we'll need. And they're basically letting us know she's a child. She did provide more than half of her own support, so she's meeting our definition of a child. So, so we have a child, okay? The parents, their marginal rate, they took her exemption, and Part A tells us that she received $7,000 from a part-time job. This was her only source of income. She is 16 years old at year end. Anyone care to comment on this? She got $6,000, $7,000 from a part-time job. No kiddie tax, okay? You wouldn't be trying to calculate kiddie tax here, okay? So nothing's gonna get taxed at her parents' rate, but you'll still work at it. Guys, this is earned income. If you work for it, it's earned income. The kiddie tax applies when there's $2,100 of unearned income. So you're thinking interest, dividends, capital gains, annuities, right? Things from property, income from property. $7,000, but they did tell us her parents claimed her as a dependent. Okay, so she's not entitled to that automatic $6,300 standard deduction. Okay, what she's entitled to, guys, is the greater of $1,000, or, oh sorry, I'm still on last year's numbers, $350 plus her earned income, okay? So here, the bigger of the two deductions would be the $350 plus her earned income. So you'd wanna say $7,350, but we can't, right? You have to stop at what otherwise would have been her standard deduction if her parents didn't claim her. And since she's single, presumably at 16 years old, okay, you would have to cap yourself at $6,300. Okay, so her taxable income would be $700, guys, and then just using a basic 7-bracketed tax system, her tax would be $70. Okay, and that's what she's going to report on her return. Part B, she received $7,000 of interest income. Okay, now we're talking about unearned income. From corporate bonds she received several years ago. This is her only source of income. She's 16 years old at the end of the year. So she's got $7,000 in unearned income. Okay. Your next step, guys, is going to be the same step we just did. Figure out what sort of deduction she gets. Again, it's going to be the greater of $1,050 or $350 plus her earned income. What are we going to take? $1,050, right? She doesn't have any earned income, so that's not going to work. You would take $350, but why take $350 when you can take $1,050? So that's going to leave her with $5,950. Okay, this is her taxable income. That's how much income we now have to tax. But because this is all unearned income in excess of $2,100, some portion of this is going to be taxed using her parents' rates. Okay, and the formula says that what's taxed to her parents is the parents' rates, so that's parents' rates, is the lesser of, this is choice one, her taxable income, okay? Or the alternative calculation says the amount of unearned income she has, okay, minus $2,100, which works out to be $4,900. Okay, this calculation is the unearned income amount minus $2,100. And you pick the lesser of these two numbers to be taxed using the parent's marginal rate. Okay, so here $4,900 is the lesser of our two numbers. So we're going to tax that at the parent's rate. $4,900. They told us in the beginning of the problem, parents' marginal rate, their highest rate, is 35%. $1,715 so far in tax. With $1,715. That's the parents' rate. Okay? You guys with me? Okay. So we've taxed so far $4,900 of the $5,950. We still have $1,950 more that we need to tax. You have to tax fully her taxable income. It's just only a portion of it here was taxed to the parents' rate. The rest is gonna get taxed to her using her rates now. So here, that leaves us with $1,050 left over to be taxed. But where you're gonna use her rates, and you start from scratch there, she's gonna be in the very lowest bracket, 10%. So she's got another $105 here. So overall, guys, her tax is gonna be $1,820. You have to include that and that.
Question, when you're trying to find out the child's tax, like his bracket, do you go by the 1050 or do you go by his overall taxable income?
Well, no, you have to look and see. Look, I mean, at the end of the day, your taxable income is your taxable income. That's what you have to pay taxes on.
Yeah.
Then we use a formula to figure out what portion of that $5,950 gets taxed using the parents' rates. Here, this worked out to be a lower number. So we've taxed $4,900, but you still have to go back and tax the remaining $1,050 because, right, she has total taxable income of $5,950, and at the end of the day, that's what needs taxing. We only use some of it at the parents' rate, so whatever's left over is gonna go to her rate. Did I not answer your question?
What if the taxable income was, let's say, over the first bracket, let's say if it was 15%.
Then you would charge, some would be taxed at 10%, some would be taxed at 15%.
Okay, so you would still go
You would
by-
follow, once you get to her numbers, you would follow the regular
So you would
rules.
kind of do the thing where you find out where you are in the first tier, how much is left, and then
You wouldn't have to do that because we're not on the preferential system, right? You would just go to the 7 bracketed system. Like if she had $30,000 of her own income, you would just go to the tax table and you would do what you would normally do, as if this wasn't going on. You would take that $30,000. I think for single, it's like the first 18,150 is 10%.
okay.
You would do your normal calculation.
Okay.
Guys, are you good with this so far? Okay. Okay. Part C, she receives $7,000 of interest income from corporate bonds she received several years ago. This is her only source of income. She is 20 years old at year end and is a full-time student. Same calculation, right, guys? I mean, yes, she's a little bit older. She's not really like a young child anymore, but she could be up to 23 years old, and as long as she's a full-time college student, she'll still apply for this rule, okay? It'll still work. So C is the same as B. Part D, she receives $7,000 of qualified dividend income. This is her only source of income. She's 16 years old again. Okay, guys, we didn't focus much on qualified dividends. If I haven't said it before, I will say it now. Qualified dividends, guys, receive equal treatment to net long-term capital gains. They get taxed at 0, 15, 20%. All those crazy calculations we did where you tax using the 7-tiered system and then convert it into the 3-tiered system, okay? Qualified dividends are treated the same exact way. So yes, we're revisiting that a little bit, not too badly though. So let's take D. She's got $7,000. It's unearned income, guys, but with me, I'm gonna make a note here, I'm gonna star it, because it's not only unearned income, it's a preferred form of unearned income, and therefore it gets an extra special tax rate. So, and then, go about it the same way. What's her deduction? She gets the greater of 1050 or 350 plus earned income. What is she gonna take, Willis? 1050. Okay. So she's got $5,950 of taxable income. Okay. Same place we were last time. The rule again says that the parents, the portion of her income tax to the parents is the lesser of her taxable income or her unearned income minus $2,100, which is again $4,900, guys. Okay. So again, we're going to tax $4,900 of her $5,950 worth of income at the parents' rates. But, right, this is a preferred rate. So we're going to use her parents' preferred rate. They told us that her parents' marginal rate, her regular rate, was 35%. So now we need to convert this back to our 3-tiered system instead of our 7 system. 35%, guys, is still in the middle range, right? 10 and 15 are our lowest brackets, taxed at 0. 25, 28, 33, 35 are our 4 middle ranges, and then 39.6 is our highest range. That would be taxed at 20%. Guys, if you need to pull that out to refresh it, do so, okay? The document we went through. So here, instead of using 35% like we did before, this time we're gonna use 15%, okay? And that is $735. So now we've taxed $4,900 of her income using her parents' marginal rate of 15%. Now we have to go back and tax the remaining $1,050 of income. And anyone want to guess what we're going to tax this at? 0, right? 0. Because again, it's preferred income. She would otherwise be in the lowest marginal bracket, 10%, but because this is preferred, she's going to use that 0 rate. So the overall tax due that she's going to report on her return is $735. Okay? And again, I don't want to mislead anyone, guys. Yes, we're using the parent's rate, but we're calculating her income tax, and it's reported on her tax return. So this 1820, that's $735. We're borrowing her parent's rate for calculation purposes, but this is her tax on her tax return, the child's. Okay?
So what is 15% of 4,900?
This one?
Yeah.
Okay, because the problem started us off by telling us that her parents had a marginal rate of 35%. But when we did this problem, they said it was her form of unearned income were qualified dividends. So qualified dividends, like long-term capital gains, are those. Yes. So because they're in the 35% bracket, they're in that tier 2. So tier 2 gets a 15% rate for preferred forms of income, which is why we use 15% there. Okay. Is everyone good with this, guys, so far? Everyone following? No questions? Everyone's on board? Okay. All right, let's do one more just to kind of drive it home. I'm going to do 55 as well, guys. We have in 2015, Carson is claimed as a dependent on his parents' tax return. Okay, so again, we know that he doesn't get a standard deduction. We have to use the alternative 1050 or 350, okay? They tell us his parents' marginal rate is 28%. His parents provided most of his support, which means, guys, that he's not supporting himself, okay? Which is good, we need to know. And what is Carson's tax liability for each year, for the year in each of the following alternative circumstances? Part A says that Carson is 17 years old, okay, guys, and that's good. He's under 18, right? He's under 18 at year end, and he earned $12,000 from his summer job and a part-time job after school. This was his only source of income. Guys, do the Kiddie Tax rules apply here? No, they don't. It's all earned income. So we have a child. His parents' rates are 28%, and they claim his deduction. So here, guys, is $12,000 of earned income. Earned income, no Kiddie tax. But they did take his exemption, so his deduction becomes the greater of 1050 or 350 plus his earned income. So what am I going to take for his deduction? 6,300, right? You can't go over 6,300. This brings him to taxable income of 5,700. Okay, and he's going to use what tax rate? His tax rate, right? He's going to be in the lowest bracket, guys, so we're going to use 10% here. So his tax is going to be $570. Okay. Part B changes it up a little bit. Carson is now 23 years old at year end. He's a full-time student and earned $12,000 from his summer internship and part-time job. He also received $5,000 of qualified dividend income. Okay, guys, for age purposes, he's 23, he's full-time, and the information up above tells us that his parents are providing most of his support. So he falls within the definition of a child, okay, that's part of the task. He does meet the definition of a child. So Kiddie Tax will apply. So in this case, he's got $12,000 of earned income, and he's got $5,000 of unearned income, and it's not any old unearned income, it's preferred unearned income to make things more complicated, okay? So he's got $17,000 of gross income. Now we want to figure out what his deduction is, okay? Same rules, 1050 or 350 plus his earned income. What are we going to take? 63. That leaves us with taxable income, $10,700, okay? Then we figure out what portion of this is going to be taxed to his parents. The rule says the lesser of his taxable income or his unearned income minus $2,100. So here it's going to be $2,900. Okay? Oops, sorry. $2,900. So we're going to go tax this using his parents' rates. What rate are we going to use, guys? Sorry, this told us, by the way. Oh, I put it over there. Anyway, they told us that was the marginal rate. What rate are we going to use? 15%, exactly right. Guys, don't forget, this was unearned, but it's also preferred. Parents have a marginal rate of 28%, so they're in the tier 2. They're in the middle tier. So we're going to use 15% instead. So that leaves us with 435. So this is the way I go about the rest of it, because now we've only taxed $2,900, okay? We have to tax in total $10,700. Some of it, guys, is earned, some of it is not earned. So you have to kind of sort through there and figure out what you're taxing at what rates, because they're not getting the same rates. So what I would do is say $10,700, okay, minus the $5,000 of preferred. This is the same way we've done it in the past, is $5,700, okay? This is preferred. This is ordinary, right? We've always said in the past when we've done capital gains, you get to your taxable income, you pull out your preferred first. Whatever is left over by default becomes your ordinary income. You tax your ordinary income first, okay? We haven't taxed our ordinary first yet, so let's do that now. So we're going to go tax our $5,700 of ordinary income at what rates? 10. It's the child. We're back to the child now, right? We finished with the parents. We taxed them, okay? We're back to the child. We're going to use 10%. Again, guys, this is because they're in the lowest bracket right now. We're on our 7-tiered system right at this moment. We're taxing the ordinary income, but this child, this is their first dollars of income, so they're in the lowest bracket. So they've got $570 of tax there, but we're not done, right? We still have more unearned income. Of the preferred income, we already taxed $2,900 to the parents, so that leaves $2,100 to be taxed, by the children, right? Now we go back and tax that. I'm sorry. Guys, what rate? 0. 0. Okay. So we've got 435, 570, which should hopefully add up to 1005. Guys, do you follow this one? Because I know this one's more complicated.
What is 2 times 0?
Okay, these are both, look, this portion is taxed at the parent rate. And you only ever tax, you're never, ever, ever going to tax any of the child's earned income to the parents. You're only ever going to tax unearned income to the parents. And because the unearned income was preferred, instead of using their 28% rate, we changed it to the parents' 15% tier 2 rate. Okay? Then we go back in. This child has $10,700 that needs to be taxed in total. So far, we've taxed $2,900 of preferred dollars to the parents. So now we have to tax whatever's left over to the kid. So I would go back and say, sorry, that looks like a 6. $10,700 of taxable income minus, this is where going back to our old rules with capital gains, pull out your preferred income, okay? The remaining $5,700 is our ordinary income. You always tax ordinary first. And now we're back on the kid. So this $5,700 is the kid's ordinary income. And because it's his first dollars being taxed, he's all in the 10% bracket. Okay? But we still have $2,100 here of preferred income that hasn't been taxed and has to be taxed to the child. Since the child's in the 10% 7-tier system, right, he gets the 0% rate. So that's why 0. Guys, good? Okay. Okay, guys, if you can do that, you can do kiddie tax, okay? Again, just keep in mind, did his parents claim his exemption? If they didn't, guys, he's entitled to a regular standard deduction. But if they claimed his personal exemption, then you have to use the greater of 1050 or 350 plus earned income. Be on the lookout. Is it earned income? Is it unearned income? Okay, if it's unearned income, the kiddie tax may apply if it's more than $2,100. And also look to see, is it net long-term capital gain or is it a qualified dividend, because then it gets the special rates. These are all the things you have to be on the lookout for, okay? Okay. So, this is the end of income taxes. We are done with income taxes now. Now we're moving on to different forms of taxes that taxpayers may have to be responsible for on their 1040. We've all reported on the 1040 once a year. And the first one that the book mentions, guys, is this new net investment income tax. It started in 2013, and it was introduced to help really pay for Obamacare. So a lot of people will call it an Obamacare tax. I think its technical name is the Medicare contribution tax. Okay, guys? And it's really going to apply to your higher earning taxpayers. Okay? So you generally need a high AGI before you pay this, sorry. And you also need investment income. If you have a high AGI but no investment income, this tax isn't going to apply. If you have investment income but you don't have a sufficiently high AGI, this tax is not going to apply. You need both. So there's some thresholds they gave us this year, and I'll bring them out quick. This is single unheaded household. So if your AGI reaches that level, and unfortunately it's not the same levels as our itemized deduction and our exemption limitation rules. Of course, they have to make it more complicated, and there's different thresholds here. But if your taxpayer's AGI reaches this level, guys, this is something else that you are now on the lookout for, okay? Because he may be subject to this tax. Now, guys, the name of the tax, the net investment income tax, guys, should sound familiar after we covered the investment interest expenses the other day. Okay, we talked about what was and wasn't included there. It's going to be most of the same forms of income, guys. Okay, we had a list of what was in the gross income, and we said it was taxable interest, it was non-qualified dividends, it was rents, annuities, okay, on like that. But we had excluded the other day. We had excluded short-term capital gains. But what's included here that was excluded there is now we can also include our long-term capital gains, and we can include our qualified dividends. So it's just different enough from the definition we covered the other day to screw us up. Okay, so I am pointing out now that this definition includes what was excluded the other day. Okay, tax-exempt interest is still left off. But now you want to pull into the definition when calculating this long-term capital gains, and qualified dividends.
Which one of those did you do that?
When we did the investment interest expense the other day, we did the calculation over there that said net investment interest equals gross investment income minus our investment expense deduction. And I put the categories of income underneath, and then I put what did not fall in the definition of gross investment income. And we had left out long-term capital gains, we had left out qualified dividends. Well, now we're pulling them in. This is what makes tax so hard, is that one day they tell you it's this, and then the next day it's something else. So you want to include it here, okay? The book makes a point, guys, of pointing out what is not included, because again, this is investment income. They're really trying to tax you only on your investment forms of income. So any sort of qualifying distributions from retirement plans. So if you get a distribution from your IRA, your 401k, it's not included in this, okay? You have self-employment earnings from your Schedule C, it doesn't count towards this, okay? What else? Gain on a personal residence is something they exclude. Of course, tax exempt interest, guys, they're not gonna tax you on that. And alimony is excluded here, okay? They're really not after your regular earnings. They're really after true forms of investment, okay? And then there are certain deductions that are allowed from these forms of income. We're not gonna cover them, but I am pointing it out. There are certain deductions that can help bring this number down, which is good for the taxpayer, but we're not gonna cover them. For our purposes, we'll leave it at this, okay? And then there's a formula, guys, and it's a lesser of formula. We're getting used to these. It's the net investment income times 3.8%, or again, the modified AGI minus our threshold times 3.8%. And you have to work through and figure out which is the lesser of these, okay? And that is your tax. It's an extra tax. Guys, again, if your modified AGI doesn't get to this level, you don't need to go through this calculation. Look at your filing status. Is your taxpayer's modified AGI? For our purposes, we'll just call it AGI. Get here. If it doesn't, tax doesn't apply. If you have no net investment income, guys, tax doesn't apply. So you don't have to do an unnecessary calculation in some cases, okay? Be wary. You have to have a high AGI and net investment income. We'll look at number 53. Okay. We have Heinrich, is a single taxpayer. In 2015, his taxable income is $425,000. Well, that's pretty high, guys. So right away, you see a big AGI, you should be getting wary, not just for purposes of this tax, also for your itemized deduction phase out, right? For your personal exemption and dependency exemption phase out. You see high AGI, you're thinking of multiple possible scenarios.
What problem is this?
53. Okay, so he has taxable income of $425,000. What is his income tax and net investment income tax liability in each of the following alternative scenarios? Okay, all of his income is salary from his employer. Does this apply? No, it doesn't apply because he has no investment income. All of his money, all of his taxable income is coming from an earned form of income. So we're not even going to bother with that one. His $425,000 of taxable income includes $2,000 of long-term capital gains and that is taxed at preferential rates. Well, now it is going to apply because now he does have a high AGI and he does have some net investment income. It could be $10 of net investment income, or sorry, investment income, guys. Then it'll work, okay? So here, if we break it down a little bit, he's got $423,000 of ordinary income, and he's got $2,000 of long-term capital gains, okay? And our formula says you take the lesser of the net investment income, $2,000 times 3.8% is $76. So that's one possible option. Okay, guys, we actually need his AGI to solve the problem. They don't give us his AGI here, they give us his taxable income, but we have to presume it's something bigger than this number because his taxable income comes lower down the food chain, right? You have to assume that he took out some personal exemptions, either standard deduction or some itemized deductions. Okay, so it's safe to presume that his actual AGI is, you know, somewhere 430, 435, maybe higher, but it's bigger than this number. So we'll use that as our calculation point, and we're safe. And guys, look, the fact is this number is going to work out to be way bigger than this $2,000 number. So it doesn't even make sense to use it, right? Because you're going to calculate the lesser of the two numbers. This number is huge compared to the other number. So, right? So in this case, guys, he's going to have a $76 net investment income tax. The other part of the problem, guys, asked you to calculate his income tax, but I'm not going to go through all that again. We know how to do that now. Okay. Good?
Which problem is this?
53. Okay. Part C, similar. He has $425,000 of taxable income, including $55,000 of long-term capital gains. Same sort of scenario. So now we have $370,000 of ordinary income and $55,000 long-term capital gain. Same calculation, guys. Again, I mean, compared to the $55,000, the other number is way bigger. So it's going to lead to a way bigger tax. So we're going to go with the smaller number. Okay, guys?
Professor,
Yes.
isn't it the MABI minus the threshold?
It is, but these problems gave us his
Right.
taxable income. And we don't know what his
Right.
taxable income
But
is.
if it say that 370 was his ABI, you would have to subtract the threshold.
Yes.
Okay.
Yeah, but this is still going to lead
Yeah.
to a way bigger number. Yes, I know what you're saying. Sorry. Yes, yes. We'll get it done. We'll do the last one now. All right, so the last part says he has $195,000 of taxable income, which includes $50,000 long-term gain that is taxed at preferential rates. Assume his modified AGI is 210. So now they're giving us a modified AGI. Okay? Should just skip the last one. Okay, now they're telling us modified AGI of 210. And taxable income, 195, which includes $145,000 of ordinary income. Sorry guys, I got small here. And $50,000 of long-term capital gain. Okay, this is what we are focused on. Okay. So for purposes of the net investment income tax, we want to look at two things. Is investment income times 3.8%, which is $1,900. Or now we have a modified AGI. So here you go, Shelley. Minus, or the threshold for single is 200,000. 10,000 times our 3.8 is $3,800. Okay, so we're still, sorry, did I do that right? 10,000. Nope, I didn't. An extra zero on there. 380. So here, this time, we're going to pick that one for our net investment income tax. Guys, it's just a formula, okay? Modified AGI minus the threshold times 3.8% is one possible scenario. Investment forms of income times 3.8% is the other scenario. Pick the smaller of the two for this extra tax. And again, it only applies when you have both, when you have investment income and you have AGI of a certain level. Okay? All right, we'll start AMT. I don't know if we'll get it finished, but so there's a whole section in here on AMT, guys, okay? This is another tax in addition to our income tax liability, okay? Guys, this tax was really designed to ensure that all taxpayers paid some minimum form of tax. There's a lot of people out there who have various forms of gross income, they have real income, but they're able to exclude it for different reasons. Maybe they have a lot of municipal bonds, maybe they receive, life insurance policies, or they have a lot of deductions that they're allowed to take. And what the code does is it kind of pulls back and says, it's a better look at really what's this taxpayer's true economic income rather than the sort of policy-driven taxable income we've been calculating up to now, right? Congress has encouraged us with a lot of deductions. They've, for double taxation reasons, pulled back on a lot of various forms of income. So we have a somewhat warped sense of what the income is with the tax code. The AMT is really designed to look at, what did you really walk away with at the end of the day? This is a more accurate picture of that. Whether or not it's really doing that is heavily debated, but that's sort of the idea behind it, is that you ended up with a certain amount of money in your pocket, and that's going to be possibly an alternative tax that we're going to tax you on. Okay? And the idea behind the AMT, guys, also is, look, it's going to take away a lot of the deductions we've been given. So we worked for our Schedule A, and we were given all sorts of stuff, and now they're going to take a lot of it back for various different reasons. So usually with the AMT, your base is going to end up being much higher than your taxable income is for what we've been calculating so far. You're going to have a higher base, but also the rates are going to be lower. I mean, you guys have seen that it uses a 26 and potentially a 28% tax rate instead of going up to 39%. So, and just to give you a feel for why these AMT are in place, this doesn't apply just to individuals, it also applies to businesses have to look at the AMT. And there's a stat, and this is an old stat, but I'm sure it's still relatively the same, that says, look, 53% of corporations reported taxable income in the year 2008. So of all the corporations out there, only 53% reported taxable income. And then if you go on from that, only 30% actually paid the tax liability after they took advantage of various credits and stuff like that. So there's a lot of people out there, I don't want to say manipulating the code, because these things are out there for our use, and that's okay to do it. But at the same time, they don't want these companies being able to structure things in such a way that they're walking away paying absolutely nothing. So fine, if you don't owe an income tax, fine, but there's a good chance you're going to owe instead under the AMT. We're going to get you that way instead. Okay. Now there's a formula in your book. The starting point for the AMT, guys, is you have to go and calculate your regular tax return first. Okay, so you would need to do everything we've done up until now, and you arrive at your taxable income, okay? And now we're gonna piggyback from here. This is our starting point. And what the first thing we're gonna do, and the most important step really, is we're gonna make adjustments, mostly up to your taxable income number, mostly up, but in a few cases we're gonna make some adjustments down from your taxable income number. Then they give us an exemption, okay? They give taxpayers a possible exemption, and what that's doing, guys, is it's protecting our lower earning taxpayers from this AMT tax. It's shielding a certain amount of their earnings from the tax, okay? Then we're at our base, okay? And there's two rates, and the numbers changed this year. I think it's like the first 184,500 or something like that is taxed at 26%. And then anything over that, you get a 28% rate, and we'll walk through some of those. Now you're at what's called your tentative minimum tax, TMT, okay? And it's called tentative because just because we calculated this tax doesn't mean you necessarily owe it. Now you have to go back and compare it to your regular income tax liability, and only if the TMT is bigger than your regular tax liability do you owe what's now called the AMT. The AMT is the difference between the two. So it's called tentative. You might have calculated something you don't definitely owe until you compare it to your regular income tax. If your regular income tax is less than the TMT, the difference is your AMT. If your regular tax is bigger than the AMT, you don't owe an AMT, okay? Okay. So let's talk about some of the adjustments, because this is what's key in figuring out the AMT tax. The first thing, guys, you're always looking for is you're going to add back, guys, any personal and dependency exemptions you took on your 1040, okay? You're going to add these back to your taxable income. You're going to increase the base. And guys, this is amounts you actually took. So if your taxpayer was subject to an exemption phase out, you're only going to add back what he actually claimed on the return, not his initial, 4,000 times, however many You're gonna only add back what you actually deducted, okay? You're gonna add back your standard deduction if you claimed it. You're gonna add it back. And why are we adding these two things back, guys? Because these are paper deductions. These aren't real economic costs to the taxpayer. These are paper deductions granted by Congress, okay? And again, our AMT is really more looking at the economics of things, and these two deductions don't fall within that definition, okay? Now, complicated, you're gonna subtract out. If you had a phase out on your itemized deductions, okay, you initially started with itemized deductions of $25,000, but because they were subject to the phase out, you only claimed $20,000, let's say, okay, you had a high earning taxpayer. Well, you're gonna subtract that $5,000 from the AMT, okay? You were only able to claim, you had true deductions of 25, but on your 1040, you only were able to claim 20 because of the phase out rules, okay? So you were denied use of $5,000 worth of these itemized deductions. For AMT purposes, we're gonna subtract them, okay? They're gonna give us this deduction now because these itemized deductions, guys, really are economic costs, okay? And you were denied a portion of it under the regular taxing rules. So now the AMT is allowing you to take these true expenses, these true deductions, so you wanna subtract them. Okay. Then we have the tax exempt private activity bonds. So we know, guys, that munis, municipal bonds, state and local bonds, the interest on them under our regular tax rules, we don't include them in our gross income, right? They're non-taxable, okay? But there are certain bonds, we call these private activity bonds, okay? And they're usually issued by municipalities. But the fact is, guys, the projects are really being done by private companies, okay? But they get this special label and they get this special tax rates because they say that these projects are for the benefit of the public. So these may be private companies, but they're building things like airports, or they're doing highway construction, or they're building, you know, a new dock somewhere, or things that are benefiting us as the public. So in this case, the AMT deduction is pulling this income in now. They're saying, wait a minute, we're not gonna let that go by tax free. It's really for private purposes. It's not truly municipality. So you have to pull that income. You were originally excluded. Now you have to pull it in for AMT purposes, okay? You're pulling it in.
You said this still doesn't include the municipal?
sorry?
You're saying this still
Well,
doesn't include
originally, we
municipal
don't
bonds?
include municipal bonds, right? If we say municipal bonds in our regular income tax, you automatically think, don't include it in gross income, tax-free.
Right.
But this is a subset of the municipal bonds where the activity is really being conducted by private parties for the good of the public. So for AMT purposes, they're pulling back slightly on that municipal exclusion. Not all municipal bonds are being pulled in here, okay? Only the portion of the municipal bonds that are for private activities.
How would we know if it's for private?
I will tell you.
Oh, okay.
But if I say municipal bond, okay, it's still tax exempt for AMT purposes. If I say private activity municipal bond, well, now you're gonna pull it into AMT, okay? That I will tell you. Okay, all of the taxes we took as itemized deductions, guys, our state, local, foreign income taxes get reversed on here, okay? We're gonna add them all back. Our real estate property taxes, we're gonna add them all back. If you paid any personal property taxes based on the fair market value of an asset, it's gonna get reversed, okay? All that whole taxing category, we have 3 taxes, we're gonna pull them all in for AMT, we're gonna add them back, okay? They're not letting us have them. Okay, the home equity, okay? We talked about 2 types of home mortgage sort of interest-related deductions, right, guys? We talked about acquisition debt. Acquisition debt is still okay under AMT. We don't have to make an adjustment for mortgage/acquisition debt. But if you took a home equity, right, we said, okay, you can deduct the interest on your home equity up to the lesser of $100,000 or the difference between the fair market value of the home minus its acquisition debt, right? Here, it depends on what you did with that money, okay? If you used it to substantially improve your home, it's okay, no adjustment needed. If you used it to buy a car, to pay off other credit cards, then you have to pull it back in, okay? Only the home equity, and only if you used it for non-home related reasons, let's say, okay? You didn't use it to improve the home, you didn't use it to buy the home, then you're pulling it back in. Okay guys, miscellaneous itemized deductions, the 2%ers, I'm talking about right now, okay? The rule says, right, guys, when we did miscellaneous itemized deductions, that was our unreimbursed employee business expenses, our tax planning fees, it was our, now we know it's the investment expenses, and what am I missing? Hobby expenses, okay? And we said you take the qualifying portion of each of those types of expenses, you add them together, right? And then as a group, you put them through the 2% floor test. And then only what makes it over the 2% is what actually shows up on the Schedule A, okay? You now have to reverse. Whatever amount you calculated to actually go on the Schedule A, whatever made it over the 2% floor, you have to pull back for AMT. Not everything, don't make the mistake of pulling back in everything, right? Only the portion that made it over the hurdle gets added back, okay? A couple more. Guys, they mentioned depreciation. I'll mention this quickly, but I'm not going to hold you to this because we haven't covered depreciation yet. When we get to depreciation, you'll see in tax, there's different speeds at which you can depreciate items. In some cases, you can depreciate at 200%, 150%, like that. They're disallowing a 200% acceleration for certain tangible personal property. They're saying you have to use either 150 or straight line. Again, I'm not going to hold you to it, but this would also be an AMT adjustment. If you're accelerating your depreciation up, you might have to pull back, okay? Skipping this page altogether. Okay, so guys, we just said that we had to reverse our income taxes, right? They weren't letting us have those income tax deductions, the state local income tax deductions. And under our tax benefit rule, guys, we have said in the past that if you took too much of a deduction last year, and then you get a refund this year, you have to pull it into gross income, right? Because you took a deduction last year, and it was too high, and then you get a refund back in the next year, you have to pull it into gross income. Well, that would never happen under AMT, right? Because you were never allowed the deduction for state income taxes under AMT, so there should be no gross income. So if you have a refund of gross income on your 1040, you're actually going to subtract it from your AMT base, right? Because again, they took back the income tax deduction. They're not allowing you to have it. Therefore, if you're showing gross income on your 1040, you're going to subtract it because it wouldn't exist without the deduction for the income taxes in the first place under AMT. A couple more and then I'm going to hit the quiz. Okay guys, there's a couple of just changes here. There are medical, okay? Under the regular code, under itemized deductions, we said if our taxpayer is 65 years old or greater, that he gets to use a more beneficial 7.5% floor versus the 10. Well, for AMT, everybody uses 10, okay? Everybody uses 10. So you would have to recalculate and say, I mean, I could do it quick. So let's just say we have a taxpayer who had a $100,000 AGI, okay? And the general rule, let's say he's 65. General rule would say that he would get a 7.5% floor, which would equal, sorry, where am I? Oh, I have, sorry, that's the key part. $15,000 of medical expenses. He's got $15,000 of qualified medical expenses. He's 65 years old. He has a $100,000 AGI. Okay? So here we would say he has a $7,500 floor. Okay? And he'd be able to deduct $7,500 on his Schedule A. Okay, but now we'd have to go back in and say, wait a minute, that doesn't apply. He needs to use a 10% floor like the rest of us. We don't care that he's 65 for AMT purposes. Now he gets a $10,000 floor. So under AMT, he gets only a $5,000 deduction, okay? So we would have to add back $2,500, guys, okay? We're gonna add back $2,500 for AMT purposes. We gave him too much of a deduction initially. Now we're gonna pull back by $2,500. Okay, guys, we'll pick up with AMT next week.